There's a specific monetary policy sequence that precedes almost every major recession in modern financial history, and it's characterized by a particular kind of confusion at the central bank. It's not the scenario where a central bank tightens policy too aggressively and crashes the economy. That's actually become rarer. Instead, it's the scenario where a central bank realizes economic weakness is building beneath the surface, but inflation remains stubbornly above target, so policymakers find themselves in a bind. They're trying to cut rates to support employment while simultaneously watching inflation refuse to cooperate with their mandate. They're caught between two objectives that appear contradictory, but are actually symptoms of the same underlying problem: structural economic weakness that rate cuts cannot fix. This policy confusion is a late-stage recession signal, and it's exactly where the Federal Reserve finds itself in early 2026. Understanding this sequence and recognizing the historical precedent is critical for retirement planning because these late-cycle policy errors consistently precede sharp market corrections. Let's examine what's happening at the Fed right now and what the specific data pattern reveals. As of December 2025, the Federal Reserve has cut rates 3 times, reducing the federal funds rate by 100 basis points from its September peak. The Fed's policy rate now sits at 3.5 to 3.75%. But here's the critical detail that most observers miss. Core inflation remains at 2.8%, which is 0.8 percentage points above the Fed's 2% target. More concerning, core inflation actually ticked upward in recent months rather than declining. According to Federal Reserve officials' own statements, they cut rates to address employment concerns, not because they believed inflation had been vanquished. The Fed explicitly stated that downside risks to employment rose in recent months as justification for the December cut. They acknowledged that the labor market was softening, but they also acknowledged they were cutting while inflation was above target. This creates a specific policy problem that virtually never ends well. When a central bank cuts rates while inflation is above target, it sends a specific signal to markets and to forward-looking economic actors. The central bank believes the economy is weakening so significantly that fighting inflation has become a secondary concern. They're no longer focused on price stability, they're focused on preventing economic collapse. And when markets recognize that shift, they typically respond by repricing downward because they understand what the Fed is implicitly admitting: recession risk has risen materially. Here's the mechanical reality. The Fed has a dual mandate: price stability and maximum employment. In normal times, these two objectives are complementary. Fighting inflation keeps employment sustainable because inflation distorts investment and hiring decisions, but in late-cycle scenarios, they become contradictory. The labor market weakens not because of excessive demand or overheating, but because of structural economic deterioration. Companies face margin compression, debt service burdens are rising, capital expenditures on AI are consuming cash without generating proportional returns. Consumer spending is showing fatigue after 3 years of strong growth. In that environment, cutting rates doesn't stimulate hiring. It can't overcome the structural headwinds. What it does accomplish is signal that the Fed recognizes these structural problems exist and is worried enough to accept above-target inflation rather than continue fighting it. The 2007 to 2008 experience provides the most instructive historical parallel, but not for the reason most people think. The conventional narrative about 2008 is that the Fed was too loose in the early 2000s, kept rates too low for too long, inflated a housing bubble, and then faced a crisis when the bubble popped. That's technically true, but it misses the crucial detail about the recession signal. The Fed didn't start cutting rates in 2008 because the economy had already entered recession. It started cutting rates in September 2007 because it recognized that housing was cracking and financial institutions were showing stress. Growth was still positive in 2007. The National Bureau of Economic Research, which officially dates recessions, wouldn't declare the recession had started until much later, but the Fed, reading credit market signals and financial system stress data, cut rates anyway. They cut into growth. They cut while economic data remained relatively robust. The specific sequence in 2007 is worth examining. In mid-2007, inflation was running around 2.5 to 2.7%. Growth was positive. Unemployment was around 4.5%. By all appearances, the economy looked fine, but in the credit markets, something was deteriorating. Bear Stearns hedge funds were failing. Credit spreads on mortgage-backed securities were widening. Banks were reporting mounting losses on subprime mortgage holdings. The financial system was beginning to show stress. The Fed, observing this stress, began cutting rates in September 2007. They cut 325 basis points between September 2007 and September 2008. That's an extraordinarily aggressive rate-cutting cycle. What's crucial for retirement planning is that those rate cuts did not prevent the recession. They did not stop the financial crisis. They provided liquidity to the system, which prevented complete collapse, but they did not alter the fundamental trajectory. The economy still contracted, the stock market still fell 57% from peak to trough. Unemployment still rose from 4.5% to over 10%. The rate cuts were a policy response to recognize danger, not a solution to that danger. They were the Fed saying, we see the problem, we're providing liquidity support, but the underlying dynamic will still play out. Now let's examine why 2026 resembles 2007. The Fed is cutting rates into growth. Inflation is above target at 2.8%. The labor market is weakening, not because of overheating, but because of structural issues. The Fed is explicitly stating that employment concerns are driving their policy, not inflation concerns. This is the exact sequence from 2007. The Fed is signaling that it recognizes economic weakness beneath the surface and is willing to tolerate above-target inflation to provide policy support. That signal historically precedes recession within 6 to 18 months. But there's an additional mechanism making 2026 potentially more problematic than 2007. In 2007, the Fed was cutting into growth, but the growth was still solid on the surface. GDP growth in 2007 was around 2 to 2.5%. Today, growth is projected at 2.3%, which is barely above long-term trend. More importantly, the composition of growth has deteriorated. The components of GDP that reflect sustainable, broad-based expansion, business investment, wage-driven consumption, exports, are weakening. The components that are driving growth are concentrated in narrow areas, big tech mega-cap stocks that have driven valuation expansion rather than fundamental earnings growth, mega-cap earnings that are increasingly driven by capex accounting rather than operating performance, wealth effects from elevated asset prices among the affluent. These are fragile growth drivers. They're vulnerable to revaluation. When they revalue downward, growth decelerates rapidly. The employment data pattern is also instructive. The Fed is cutting rates because unemployment has risen from 3.8% in early 2024 to 4.4% to 4.6% now. That's an 80 basis point increase in 1 year. More concerning, the composition of job creation has shifted dramatically. In 2024, job creation was distributed across sectors. In 2025, virtually all job creation was in healthcare and hospitality, sectors that are heavily influenced by demographic factors rather than broad economic strength. Every other major sector has either stalled or contracted. Manufacturing has been declining for 8 months. Construction employment has fallen. Retail employment has declined. This employment pattern suggests that the underlying economy is weakening, and only sectors insulated from cyclical pressures are still hiring. Here's where the Fed faces its policy trap. If they continue cutting rates aggressively and current market pricing suggests 2 to 4 additional cuts in 2026, they're betting that rate cuts will re-energize hiring and economic growth. But if the weakness is structural rather than cyclical, rate cuts won't work. Companies aren't holding back on hiring because interest rates are at 3.75%. They're holding back because margin compression, debt burdens, and uncertain demand are making them cautious. Cutting rates to 3% or 2.5% won't change that calculus. What will happen instead is that rate cuts will provide temporary stock market relief, lower borrowing costs briefly, but ultimately fail to reignite growth. By mid-2026, the Fed will recognize that the cuts aren't working. Growth will continue to decelerate. Unemployment will continue to drift higher. And at that point, the policy error becomes clear. The Fed cut rates preemptively, signaled recession risk through that cutting, markets repriced downward, but the cuts didn't actually prevent the recession. They just front-loaded the recognition of it. The financial markets' response to the Fed's December cut is instructive. Stocks rallied initially on the cut, but the rally was muted and short-lived. The Nasdaq gained less than 2% in the weeks following the cut. Small-cap stocks that typically benefit from rate cuts showed mixed performance. Credit spreads on junk-rated bonds widened rather than narrowing, suggesting that even though rates were being cut, market participants weren't convinced the cuts would solve the underlying problems. That mixed response is characteristic of late-cycle Fed cuts. They don't generate the typical stimulus effect you'd see from mid-cycle cuts, because markets recognize the cuts are born from desperation, not opportunity. Another mechanism making 2026 particularly dangerous for retirement portfolios is the policy error amplification. When the Fed cuts rates into growth and inflation remains above target, it creates uncertainty about policy direction. Investors don't know whether the Fed will accelerate cuts, pause them, or reverse course. That uncertainty itself is economically damaging. Businesses can't plan capital expenditures confidently. Workers can't negotiate wage contracts with confidence about real returns. The policy uncertainty compounds the structural economic weakness, and when uncertainty combines with structural weakness, the correction tends to be severe. Consider the contrast with a scenario where the Fed would have simply held rates steady. If rates had remained at 4.5 to 4.75% while the economy softened, markets would have had clarity. The Fed isn't changing course. Business and workers would adjust expectations accordingly. The adjustment would be less sharp because the expectations would have been clearer earlier, but by cutting rates, the Fed introduces additional uncertainty. Will they cut more? Will they pause? Will they have to reverse course when inflation doesn't respond to cuts? That uncertainty drives volatility and amplifies corrections. The specific timeline is crucial for retirement planning. If the Fed begins cutting rates in late 2025 and early 2026, and if historical precedent holds, recession typically manifests in financial and economic data within 6 to 12 months of the initial preemptive cuts. That suggests the recession window is approximately mid-2026 through mid-2027. More specifically, Q1 2026 earnings season, April-May, is likely to show the margin compression and growth disappointment that triggers the next phase of selling. The SOM rule triggering would typically occur in Q3 2026 or Q4 2026 as unemployment continues to rise. The market bottom typically comes 6 to 9 months after the recession is officially recognized, which would put that around late 2026 or early 2027. For someone in retirement, this creates a specific vulnerability window. The time between now and mid-2026 is the window when the worst of the portfolio damage is likely to occur. The Fed cutting into growth is a green light for investors to position defensively. It's not a green light to buy. It's not a green light to hold concentrated positions. It's a signal to reduce risk. What makes the policy error particularly insidious is that the Fed cannot easily reverse course once rate cuts have begun. Once they start cutting, stopping or reversing the cuts is interpreted as a sign that they believe recession is already underway. They'd rather accelerate cuts than pause them because pausing signals capitulation to recession fears. So the Fed becomes locked into a cutting cycle that they recognize isn't solving the problem but can't stop because stopping would be worse. This is exactly what happened in 2007-2008. The Fed couldn't pause cuts without markets interpreting it as recession admission, so they cut all the way down to zero and still the recession unfolded. The inflation aspect adds an additional layer of danger in 2026. Unlike 2007, when inflation was low and stable, inflation in 2026 remains sticky above target. If the Fed's rate cuts don't generate sufficient economic weakness to bring inflation down through demand destruction, the Fed faces a new dilemma. Do they keep cutting even as inflation accelerates, or do they pause and accept recession? That's the worst-case policy scenario. It paralyzes the Fed and prevents effective policy response. For retirement portfolios, the defensive positioning is critical right now. The window to rebalance, to reduce concentration, to build cash reserves is closing. Once Q1 2026 earnings arrive and the margin compression becomes undeniable, the defensive positioning will be much more expensive to implement. The portfolio will have already declined 15 to 25%, and selling at those depressed levels is far more painful than selling at current levels. The specific recommendations are straightforward. First, reduce equity concentration, particularly mega-cap growth exposure. The Fed's rate cuts are a signal that growth is weakening. Mega-cap growth will likely underperform. Second, increase bond and cash allocation. If a recession unfolds over the next 12 months and markets decline 30 to 40%, bonds and cash become dramatically more valuable both for stability and for rebalancing opportunities. Third, establish a written rebalancing plan. When the SOM rule triggers or earnings come in disappointing, you want to execute rebalancing rationally according to plan, not emotionally in response to market panic. Fourth, stress test your retirement plan. If your portfolio declines 35% and remains depressed for 18 months, can your withdrawal rate still be sustained? If not, the time to adjust is now. The Fed rate cut trap is closing around us. The Fed is cutting rates into growth. Inflation is above target. The market is recognizing the recession signal embedded in the Fed's actions. Historically, this policy sequence precedes sharp market corrections within 6 to 12 months. The 2007-2008 experience showed that Fed rate cuts don't prevent recessions that are driven by structural economic weakness. They just acknowledge that weakness and provide temporary liquidity support while the correction unfolds anyway. Your retirement security depends on recognizing this signal and positioning defensively before the market reprices the risk that the Fed has already priced into its policy actions.